In this video of short-term business decisions, we're going to be specifically looking at discontinuing a product line and how that becomes profitable or less profitable for a business. We'll be using the incremental analysis approach as well as the income statement approach. So here we have a problem. Members of the board, they're surprised that the industrial systems product line is losing money. They commission a study to determine whether the company should drop the line. Company accountants estimate that dropping industrial systems will decrease fixed cost of goods sold by $85,000 and decrease fixed marketing and administrative expenses by $13,000. Now, this is an important sentence because these are fixed costs. Typically, fixed costs are going to stay fixed whether we get rid of a product line or not, but in this case, some of them actually will go away. So we have to pay really close attention to that sentence. So the first thing we're going to do is prepare an incremental analysis to show whether Security Force should drop the industrial systems product line. All right, so here I've got the data up in the right-hand corner there, and this is our incremental analysis I've already got prepared. And we're going to go through and determine if it's going to be profitable to drop the product line or not, because an incremental analysis just shows the differences. So in other words, how much will revenues decrease? Because if we drop a product line, we're going to lose all the revenues that are associated with that product line, but we're also going to be able to get rid of the expenses that are associated with that product line. So the first thing is the revenues. So we can see up here in the the data part of the problem that this is our sales revenue. So we're going to lose $320,000 in revenue if we drop the industrial systems product line. So now let's look at our expenses. So we have variable. Now notice that our data table up there is a gross profit income statement. And our analysis is broken apart in variable and fixed. So you have to be very careful when you're looking at these expenses not to get them mixed up. So the first one here in our analysis is variable expenses, cost of goods sold. So we'll actually be able to get rid of all those variable cost of goods sold. So if we look in the chart here, our variable cost of goods sold is $38,000. And our variable marketing expenses are $67,000. Now, as far as fixed expenses go, that's where we have to pay attention to this sentence in our story up here, where they tell us that our fixed cost of goods sold, we'll actually be able to get rid of $85,000 of those costs, and we'll be able to get rid of $13,000 of our fixed marketing and administrative expenses. So if we add those four expenses up, I believe they come out to $203,000. And if we subtract that from our revenues, we end up with a loss of $117,000. So a decrease in operating income of $117,000. Now that is the incremental analysis method. Well, let's take this information that we now know, because we actually now know the answer that we should not drop this product line because it's going to decrease our operating income by $117,000. So now let's look at the income statements just to verify what we already know. Go ahead and put that in the story for us. And now we want to create an income statement without the industrial systems. So if we go through this, now we're talking about what will revenues be if industrial systems weren't there. Okay, so for example, this stuff would go away. So we wouldn't have that $320,000 in revenues anymore. So we would only have the revenues from the household systems. So our revenue would only be $340,000. Now we can get into our expenses. Again, notice we're doing a contribution margin income statement, so our variable and fixed expenses are separated here, and our data is given to us in a gross profit income statement. So we have to be very, very careful that we keep those things in our mind as we're going through here. So the first thing we want to get rid of is our cost of goods sold for the industrial systems and our marketing and administrative expenses for the industrial systems. And those are variable. So we would get rid of the 38,000 and the 67,000. So we would have $45,000 in variable cost of goods sold left, and we would have $70,000 of variable marketing and administrative expenses left, for a total of $115,000 in variable expenses, leaving us with a contribution margin of $225,000. Now we move to the fixed expenses. And again, fixed expenses normally do not go away, but in this case, we are going to be able to get rid of some of our fixed expenses by dropping this product line. And again, they are up here in the main story, 85,000 and the 13,000. So we have to pay really close attention to that. And go back to our total. So our total cost of goods sold was 317,000. We're going to be able to get rid of $85,000 of that. So 317,000 minus 85,000 would be the amount of cost of goods sold that would remain in fixed cost, the fixed cost of goods sold that would remain if we got rid of the industrial systems. And that is $232,000. Then our marketing administrative expenses totaled $65,000, and they tell us in the story that we can get rid of 13,000 of those. So 65,000 minus 13,000 is $52,000, giving us total fixed expenses without industrial systems of $284,000, and giving us an operating loss of $59,000 without the industrial systems. So the last column is the change if industrial systems were dropped. So I would like for you to pause the video and finish this last column. Then once you've finished it, calculating the changes between column 1 and column 2 there, come back and we'll take a look at the answers. Okay, so here are the answers to the last column. And you can see that sales revenue would decrease by $320,000. So that last column should look very similar, if not identical, to your incremental analysis that you did earlier. The one thing I want to point out here is this last line here. When you were told to get the change, you have to be very careful with this one. You kind of have to think about this one on a number line. Because if you take 58,000 and subtract 59,000, you're not going to get 117,000. So you kind of have to think about this on a number line. So if we think about the 0 being there, and we think about negative 59,000 being here, and a positive $58,000 being here, you have to count between these two numbers. So between a negative 59,000 and 58,000, how many is actually there? And it's actually 117,000. And we went from 58,000 down to a negative 59,000. So operating income decreased by $117,000.